Good morning, everyone. We might as well get started, and congratulations for making it to this morning's private equity panel discussion. The outline of today's discussion will be why should people invest in private equity, where private equity essentially sits today. The panel will also discuss some key considerations in respect to building effective portfolio equity portfolios. How can you make the best out of private equity investments in a late cycle? And also talk about some preconceptions and myths surrounding private equity. So our speakers today are Tania Freeman from JANA and Marcus Simpson from QIC. Tania is a senior consultant at JANA and a member of the private equity research team, and Marcus is the head of global private equity. The format is basically a panel discussion, and we'll open it up to the floor for questions a little bit later on in the session. We have a number of polling questions which will go up on the screen. So if you could put your answers in on the ASI app, that would be fantastic. Have they come up yet? Here they come. And while you're answering the question, I'll just ask Tania and then Marcus to give a brief background of their experience in private equity.
Hi, I'm Tania Freeman thank you, Paul. As Paul mentioned, yes, I'm from JANA Investment Advisors. So JANA is a leading investment consultant in Australia. We have one of the largest teams of about 100 people based across Sydney and Melbourne. JANA has about 100 institutional clients, and they cross the spectrum of industry super funds, public and corporate sector funds, and also a range of other charities, insurers, and pension funds. And we advise across the spectrum from asset allocation to more asset class specific consulting as well.
Thanks, Tania.
Hi, I'm Marcus Simpson from QIC. QIC is a government-owned asset manager starting off by managing the defined benefit plan for the state of Queensland over 20 years ago. And we've since grown to be a major alternatives investment manager with 1,000 people globally and a real focus on the private assets, real estate, infrastructure, and private equity. But we also do fixed income securities, and we have a GMA function as well. And grown now, so we have over 110 clients. I came over from the States 15 years ago this month to start the private equity program, having built a number of programs for institutions and also for clients globally. And we currently manage $7 billion from offices here in Europe and in the US, and we invest globally for clients in private equity funds, co-investments, and also secondary interests as well.
Fantastic. I don't think we've rolled through all the polling questions yet. There might be one more to go, so we might as well say that. We might as well kick off the panel discussion. There's obviously been a significant amount of development in private equity over the last decade or so. What are your views about what private equity offers investors today, in today's market? Tania, do you...
Yeah, so I think the sort of value proposition to investors that private equity offers is sort of threefold. So first, it's really like the growth engine of your portfolio, and that's particularly relevant in the era that we're in now, where it's sort of a lower for longer returning environment, where, you know, in order to meet fund objectives, trustees are going to have to look at sort of how to deliver them when some of the other asset classes are not actually able to deliver that. So I think historically private equity has outperformed the listed markets by sort of around the 300 to 500 basis points across most time periods over the last 20 plus years or so. So historically, it's performed very strongly as a return driver in the portfolio. The other thing I would say is that it also provides some diversification benefits, and these are probably going to become even more pronounced due to some secular changes that we're experiencing, which Marcus and I will touch on later on in the panel. And what this does is it gives exposure to certain sectors and companies that one can't find in the listed markets, as well as the sort of inherent return drivers that are differentiated from the public markets. So you have idiosyncratic risk that is different from the listed markets. So it brings a combination of those two diversification benefits. The last point, which is also, I think, on the ascendancy with private markets, or private equity in particular, is that it gives investors access to the new world economy. So this is the drivers of growth that will be important for future generations, and it harnesses innovations and new technologies that are coming to the fore. And that's important because it brings insights to investors that can be applicable across the whole portfolio. So you can almost get a leading indicator for other sectors that might be exposed to disruption risk or technological change, which is extremely valuable. And we'll touch on that later in the panel as well.
I think private equity is an asset class that has been around for a long period now, sort of 30 years plus. It is underrepresented in Australia, as we sort of saw from the allocation to private equity for a number of reasons. I think that's beginning to change here, but certainly overseas it has been a tremendous experience when it's been well executed in terms of institutions trying to generate alpha. And for our clients over the long term, we've been well above that 5%, kind of 3 to 5% target. We've been sort of 7% for the program we've run for clients at QIC, 7% per annum outperformance over the public markets since we started in 2005, and we've done it for previous clients in the past. And I think a lot of it is what Tania has alluded to, which is company building, a better alignment of outcomes to the people who are involved in the outcomes, from the CEOs of the portfolio companies through the people who are managing the companies. Ability to be able to build longer term growth in the public markets versus more focused just on kind of EPS per quarter in the public markets. And I think, we have one portfolio company, for example, that we bought a couple of years ago, and at that point in time, part of the plan was to take it public in 3 to 4 years' time. And I think now there are a lot of owners of the business still in that business, and I think people are going, well, why do we want to go public? The visibility is too high, the legislation is too too constricting. And if you actually look at the proportion of companies on the public index and the growth of those companies, 4 to 5 years ago, it was 40% of companies in the MSCI world were growing at 8% or above, and that's now fallen to 20%. So where's the growth? The growth are in the private companies that are staying often private for longer. And in our portfolio, we have Airbnb, for example, staying private longer. We have Didi, we've had Facebook, Snap, kind of you name it, Instagram, you name it, it's in there. So we have a lot of growth on the tech side, but also on more sort of operating businesses, including, for example, Icon Cancer Care. That's Australia's largest integrated cancer care business, growing at sort of 10 to 15%. So that's where the growth is.
Marcus, you mentioned that private equity is underrepresented in Australia. Is that because of various myths and misconceptions of private equity?
Oh, I think you're right. I think private equity does a very bad job with the PR. I think there are a couple of reasons why it's underrepresented. One is that there's a construct in Australia that doesn't exist anywhere else, where you have superannuation choice, you have encouragement to build programs on the basis of an MER budget, not on net returns. And private equity is very expensive to to implement, but done well can make a real difference at the top level. And in the context of this market means you could change from an orange light to a green light, for example, done well. The other thing that's kind of held it back is that there was sort of an early execution model that's sort of now faded 15 years ago, where a lot of pension plans invested all their allocation into Australia, which is 2% of the market, so they swamped the market. Used a lot of funder funds, and then when they went overseas and backed typically big buyout funds just before the GFC, so it's kind of like a triple whammy. Not great returns, bad experiences, and we still find that often amongst board members who remember those days.
Tania, you mentioned investment in various sectors. Maybe you could give the audience a bit of a view of how broad those sectors are and whether they're concentrated into a few particular areas, you know, like biotech or technology and or asset classes like that.
Yeah, so I think there is a, to Marcus's point, you know, I think Australian super funds as a generalisation are underweight to growth. So the sort of sectors, you know, that are going to form the basis or the backbone of the new economy as we go forward are very much tech-related or tech-enabled. So you have everything from, I think, biotech through to clean tech, fintech, agri-tech. Every sector, I have heard, you know, technology being described not as a vertical sector anymore, but more as a horizontal. It is touching every sector, every industry, every business model is in some way being shaped by technology. So in some ways it's not really just a sector, but it's actually dispersed much broader than that into almost an economical imperative to get some of this exposure to this new economy, I think.
I guess I've got an audience question which runs into that is, as funds get larger, is there more focus on private equity or does interest move towards venture capital? Is that something you...
Yeah, look, I think for the way at JANA we like to think of private equity is that it actually is a fundamental driver of growth in a portfolio, and that's irrespective of fund size. Obviously, you know, if you're a smaller fund, you may not have the liquidity, illiquidity, or the profile to absorb large licks of illiquidity, but because there are some secular shifts around where growth is going to come into the future, you know, there should be some exposure. Now, you know, in terms of actually constructing a portfolio, you know, we like to think of it in terms of there is a core, a basis of the private equity program of which you can have exposure to sort of a lower risk, lower returning profile, strategies such as buyouts, but then you can complement that with more of a satellite exposure to something that is a little bit more high, traditionally seen as high risk, high returning venture capital, but tactically you can also be more opportunistic and flexible to shift to market conditions. So I think private equity as a bedrock of a investor's portfolio is important to deliver the growth, especially in a low and slow sort of economic backdrop, but you can always customise it to fit the client's profile.
Marcus, there's talk about, well, there is at a concurrent session today about late cycle investing. Could you give us your views on late cycle investing within private equity?
Yes, no, happy to. I think that private equity programs, the best ones are perennial programs. So people put in place an allocation and they build to that allocation and they keep that allocation. I think what's very, very hard is to market time. We actually started the program at QIC just before the GFC. We were very light to invest. We did a lot of venture tech investing when it was actually out of style. So there are lots of things you can do late cycle. In terms of the research shows you that if you segment a cycle into 4 segments, so you have the downturn, you're in the downturn, and then you come up, and then it's sort of what we've had the last period of time, which is sort of stable growth. The only time that private equity underperforms is when you're coming out of a recession, so public markets tend to rocket out, and in part because of conservative valuation, private equity tends to lag behind. And it doesn't tend to be as bad in a downturn as people might think. So yes, we are cautious. We have been cautious for a while, but we're still investing.
Tania, do you have a view on that?
Late-stage investing. I think, as Marcus said, it is a long-term asset class, and, the way we position private equity is that it's something that you should be thoughtful about, and in terms of allocations, it should be consistent allocations through a cycle. That said, I think there needs to be probably a little bit more scrutiny about, the core managers, just their underwriting standards, are they keeping disciplined? Have they been cycle tested? Some of these questions come to the fore during a late cycle, but we think that the diversification that an even-paced allocating program over the long term means that you actually need to be deploying even when it's late cycle, early cycle, across the stages.
Okay, we might move on to building portfolios, and we'd be interested to know what considerations that you guys undertake when you're building quality portfolios. So maybe Marcus.
Well, I think when you're building a portfolio, it should be for the long term. And I think it's very important when you're putting a program into place that you get buy-in from all stakeholders, board, IC, team, and then you should build a portfolio that meets who you are. So some institutions are able to have a lot of resources and build a portfolio directly themselves or outsource some of it. And other institutions, don't have as much resources and prefer to fully outsource to service providers like QIC, advised by JANA. I would say also take your time. You're going into this with a view of kind of a long-term marriage versus a short-term fling. So I think you should get up to speed as much in terms of what it's going to look like, what your choices are. You're drinking from a fire hose in terms of investment choices around the world. So do as much planning in advance before you put a program into place. And I think to Tania's point, constantly reassess the program and where you are and what's going on in the cycle, and communicate that back to the stakeholders so they're very clear in terms of what they're getting.
So what sort of life cycle are you looking for in your portfolios or your private equity portfolios?
So for all the clients I've dealt with over the years, all of them, apart from two, still have private equity programs in place. Now, underneath that, the portfolio companies change. So typically in private equity, you're buying a business, building it in the venture sector, or you're transforming it in the buyout sector, and then you're selling it after sort of 4, 5, 6 years. So underneath, the portfolio looks differently. The way the managers invest and the way that we invest is completely different now to 10 or 15 years ago. So there's constant evolution underneath.
Do you guys have a view of what size stakes you normally take in portfolio companies? Size of commitments?
Again, it depends who you are. I think our preference is that we like growth, not financial engineering and leverage. So we tend to grow more on, it depends on definitions, kind of small microcap venture. So a lot of times in a company we're investing $20 to $50 million into a fund that's 500 to billion, billion and a half, or a company whose EV is, zero if it's a startup. Or if it's a more mature company, sort of 500 to billion and a half.
So, Tania, what sort of due diligence do you do on your investments?
Yeah, so I think, it depends again if it's a manager selection process. We will invest a lot of time in actually getting to know the manager. So it's, a relationship that you sort of build up over the years. We'll get to know the team, everyone from the senior members, but all the way down to the guys that are doing maybe the bulk of the work, the analysis. So it's a long-term sort of relationship engagement. Because at the end of the day, I guess private equity is no different from a lot of other businesses. It's really about its people and the quality and calibre of the people. That said, we will do all the traditional aspects, look at the team, what the strategy is, what their track record, the performance, has there been any style drift, what they're looking at, how the market's changed, how the team's succession planning, alignment's very important as well, just to see how the firm thinks about, bringing up, the team and then incentivising them appropriately, because private equity is such a long hold investment. You want those guys, you want them committed for the long term to delivering the outcome as well.
There's always been a number of traditional sort of concerns about investing in private equity, and you've just mentioned one there, liquidity. How do you, both of you go about managing liquidity risk and creating appropriate exit plans for your fund clients?
So I would make a comment that I think, there's a couple of, I suppose, misconceptions about private equity. One of them is that it's, extremely illiquid, which, look, you wouldn't go into private equity investments thinking you can just get out in 1-2 years' time. But I would say that the secondary markets across all the different strategies have actually got a lot more deeper and sophisticated and matured, and such that, investors are able to obtain partial or full liquidity exits on their portfolios in some of these markets. There's the rise of sort of GP-led restructures. They're constituting about 25% of the secondary market, which is a way for, I guess, managers to maybe extend the fund life, but also give optionality to LPs to be able to get out at a sooner juncture than perhaps the fund life would have. So there is many more options on the secondary markets, as well as the traditional sort of exit routes through at the end of fund.
And I think the liquidity is sort of one of the reasons why you don't see 40% allocations into private equity. And compared to some other private asset classes, private equity is naturally liquid because we're selling companies all the time. So if you stop investing, that exposure will come down. To Tania's point, we've actually had some clients who, for sort of strategic reasons, have got out of the asset class. And we've actually sold their portfolios, sold parts of their portfolios by number of interests. We did either the largest or the second largest sale globally last year, and we've sold about $3 billion of exposure, and that market has increased now to sort of $70 to $80 billion of trading. One head GP of a private equity firm said, actually, I don't understand this whole liquid thing, because if I wanted to get out of the business and sell my entire portfolio tomorrow, I could do that. I could sell it at the valuation. Fees
is often talked about. Where do you think the fees are going? Are they appropriate for the services which are being provided? Maybe Tania, you can start off.
Look, I think, it is, as Marcus mentioned earlier, it should be really looked at as a net return basis. And on those metrics, private equity is very strong. I mean, standalone, if you just look at the fee load, it is quite high relative to the other asset classes. But that has come down over the years as well. That's probably one of the misconceptions, or where, everyone's still stuck at sort of 2 and 20 as the sort of base and outperformance. It's probably more realistic to say so as 1 to 1.25, but still around 20 over 8 as the performance fee. But that has to be put in context, because what private equity delivers is a net return which is far superior to other asset classes. So really that's the end result, and that's what should really be assessed. But having said that, there is a fee sensitivity with the Australian market.
When I came, so first coming to Australia, I actually had never heard of the expression MER, and all the other portfolios globally had a focus on net returns. I think increasingly now there's more of a focus on fees. But the very best managers who consistently outperform the markets who you want to be with, and we're with 30 managers out of a global opportunity set of between 8,000 and 9,000 managers, they often have very high fees, but they produce very good returns. And a couple of our venture managers have a 30% performance fee. But their returns have been just through the roof, because in venture you have to be with the very best managers. I think that there are ways that you can reduce fees, and certainly one of the biggest changes on our side of the table, and what JANA would be doing as well, is that in the old days, you built portfolios purely of commitments to private equity funds. You paid a lot of fees up front, no guarantee of returns. I think with the newer model, you can do co-investing where you have money in the ground a lot earlier, more directly under your control. And also you can do some secondary investing day one to help kind of mitigate that fee drag.
There's also the perennial concern about the accuracy of valuations. What do QIC and JANA do to minimise that risk and to really drill down into the valuations you receive, particularly from portfolio companies and the like?
Look, I think, there are standards for how private equity, like all asset classes, should be valued. So, I don't think, personally, that is too much of an issue. It's like any unlisted asset class where, you don't have perhaps precise market comparables that you can compare to, but the basis, of actually getting to those valuations based on sound principles, I think, Marcus?
Yeah, no, we scrutinise them a lot, and also increasingly we're directly in companies as well, so we have a much closer line of sight to what's going on in the business versus the valuation. One thing we've always tracked is, and you do get kind of the proof is in the pudding test with private equity, because you are constantly selling companies, and we've always tracked what we call the pop at exit. So I think, we still find that on the aggregate, when we're selling companies, we're getting 15 to 20% above the last round of valuation. So I think that's a good kind of back test that there's good conservative valuations happening.
And this also flows into, particularly now that super funds are expected to provide a higher level of detail about their underlying assets. How are you working on transparency issues and getting the funds the specific information they need without the pain of having to drag it tooth and nail out of managers and portfolio companies? So, question for both of you, I guess.
I think that's another area of transparency where the private equity market has matured and evolved. So, if you're a manager and it's a competitive marketplace for capital, and so if you're a GP, investors have also become more sophisticated and better educated around private equity, so they are asking more incisive questions, but also requesting more information. So in order to remain competitive and attract capital, you do need to be more open about your process and share more information. That is actually being demanded increasingly by LPs.
And the data systems have dramatically improved as well. So through the data feeds that we get that are electronic from managers, we're able to track a lot more portfolio company information about which ones are growing, which ones are not. Now, there still are a few managers, particularly in the venture space, where we get limited value because they, really do not want to have the risk of a leak about valuation of one of their companies coming out. We have very close relationships with them. We just don't get as detailed reporting, but that's probably 10% of the portfolio. The rest of the portfolio, the information's really improved.
Just going back to the question of fees, got a question from the audience. Is the best way to avoid high fees to avoid fund of funds double layer of fees?
I think the traditional fund of funds industry, which is you raise a pooled fund, you get 100, 200 investors in, you charge them, what would it be, about 1 in 5, 1 in 10? and you put together a diversified portfolio of private equity funds, that business has been dead for about 15 to 20 years. So there used to be 40 fund of funds raised a year. It's now probably 2 to 3. Some specialized fund managers do well, like in the venture space. I think for most people now, it's like kind of a club structure or a single managed account, specially managed account, where we can put a lot of the levers into place and we can drive down the cost. So that traditional fund of funds model would be about 1,000 basis points. So if a company returned 20% gross, and a lot of companies we're looking at, we're expecting 20 to 23% gross, you get 20% gross, 10% net. I think we've been able to narrow that down to around sort of 450 basis points in terms of what we do for our clients.
So when building a portfolio or running a portfolio, obviously ESG issues are now coming to bear on trustees, including from a legal obligation. How do you structure ESG into your portfolio so it's not just a lip service but actually is an effective strategy?
So I think ESG, it is it has come to the fore, and it is definitely one of the key considerations. But I would still say, overwhelmingly, net returns and the pursuit of those is probably is the key outcome. That said, ESG is not incompatible with that, and in many cases it's just about good business practice. And I would say, private equity actually sits at, in terms of the rankings across our different managers, both listed and unlisted, they're at or above market practice with the more established PE managers. And you can sort of see how that can come to pass, because not only are they, ESG is filtering down through the investment selection process for managers, but also they are able to actually influence the direction of ESG being implemented at the portfolio company level. I mean, that is what they do. They're actually actively involved in those businesses, so they can oversee and actually make sure that happens at a company level with the management team. And so I think in terms of ESG implementation, it really is quite fulsome in private equity and quite, on the better end of the spectrum.
No, I absolutely agree, and I think that control aspect means that you can do a lot more in ESG. I would say managers are probably slower to get on the journey than the institutional investors, but I think that's changing rapidly. And I was reading a paper this morning about in the US, workplace health and safety incidents had actually declined under private equity owned companies for a number of reasons. And just to give you one example, we are the controlling investor in one of the largest beef operations in Australia. We're doing a lot of work on ESG. We've just produced, and I hope you find it in restaurants, called Five Founders, very first carbon neutral beef product, branded. But also we're doing things like on these cattle properties, there are a lot of those very traditional windmills, and they're dangerous. And people in the industry have fallen off the windmills and killed themselves. Very sad. And so what we've done recently is had a discussion on the board, well, what do we do about these windmills? Recommendations came back. Take 5 years, take them off, and you can replace them with solar pumps. And I think as a board, we went back and we said, no, this is really serious. We really care about our people. And so we've decided to accelerate the removal of all these windmills, and they'll be gone by the end of next calendar year. So that's kind of ESG in action, and be able to have direct control of the company and drive things through quickly.
So have you got any other examples of sort of ESG promoting capital growth as a driver to a portfolio company, are growing, I guess? Tania?
Not precise examples. I mean, through, the due diligence process of managers, we do ask for those specific examples, and it ranges from everything to sort of reducing carbon footprints to having more sustainable practices in the supply chain. But it's across the board. So I think, and that goes to that point around ESG being actually implemented down to all aspects of a portfolio company's approach, because it is good practice, but it also is across a broader spectrum, I think.
It's very broad, and it goes from diversity to child labour, and we actually have an in-house ESG function, and they really kind of help to guide us so that we can put kind of best-in-class practices. We get graded. So, people love to get graded, and then they can try and do better next year. We're at an A now, but we started at a B. So they've been very helpful in terms of this broad suite of things that you can do, helping us on the journey.
Do you think trustees need to be a bit cautious when embedding ESG principles in their investment strategies, that they don't overreach and create objectives which are unachievable in today's environment as yet?
I think that's a really good question. I think in the past, to Tania's point, I think people wanted returns. I think people now want returns, but it's invested well, and it's invested in a good manner. It's interesting now that actually people on the street can actually choose. So if I'm really, really keen around ESG, I can actually back a superannuation fund where that's all they do, and maybe I'm less concerned about returns, I'm more concerned about doing good. And I understand there's a vegan fund. So if you're really into veganism, you can actually go switch your money from, unfortunately, somebody in this room over to a vegan fund, so you can vote that way. I think for trustees, as long as what do members want? Well, members want their beneficiaries when they retire to be able to afford good healthcare service versus not have any healthcare when they retire. So that's probably first and foremost, and then invest well.
And just to round that off, do you think private equity has a place for doing good for society and the economy in general? Tania?
Yeah, look, I think it really does have an overweight role, and particularly, the frame of reference I'd use is probably on the venture capital front. So, in terms of helping new businesses, new innovations get funded, these are the very early stages of that journey of those technology or innovations, and often there isn't any other capital apart from maybe some government funding to get those things off the ground. And those are the sorts of things that I've alluded to are going to shape the new economy. So private equity and venture capital in particular has an outsized role in helping nurture that sort of ecosystem to develop, which I think is going to be extremely important for the future.
I think it's a great model to grow companies, and the Icon Cancer Care business that we've grown, their patient interactions have grown from 1 million a year when we bought it 2 years ago to 2.3 million patient interactions now, and their staff has grown by about 30%. So growing companies can do well. I think there's a misconception that it's all about cost out and firing people. In building any business, that only gets you so far. I think that there is a lot of job creation in private equity, and it's not about driving prices either. There was a piece of research done in the US, came out last year, where they looked at private-backed companies versus their public equivalents, and they looked at 1.7 million SKUs in shops in the US. And they found that the private equity-backed companies had grown the prices of their core products that they started with by 1% per annum. But these companies themselves had grown by 53% in terms of revenue over 5 years. And the way they'd done that was actually to go into new countries and to go into product expansion. So I think you see a lot of that versus, we're going to tear this business apart and fire all the people.
And that goes to your point, Marcus, earlier that, the PR for private equity has probably been on the, job cost out sort of side rather than the sort of job creation or the actual benefits side.
Excellent. We might pause the panel discussion and throw, get some questions from the floor. I've got a few questions here already on the app, although I've just lost them. Oh, they're back. Certain expenses which used to be offset against management fees are no longer, so have fees really been reduced, Tania?
I think on the whole, yes, they have, because not only are you seeing the sort of headline fee number, so the 2% that I mentioned earlier, sort of become more sort of like the 1.25% for the base fee. But also, you know, the way it's levied has changed. So instead of on sort of committed capital, it's much more on invested. So it's actually the amounts that are in the ground versus the size of commitment. So I think it has. Now, I know there's nuances, obviously, with the MER calculations, but we haven't really seen an erosion of how managers do the fee offset in a significant sort of way.
Particularly at this point in the sector, some managers will push the fees to their advantage because many of them are just heavily oversubscribed. I think most of our managers in the middle market, what we like are managers who actually get really excited about capital gains, who get 20% of the gains that they generate from their portfolio companies, and they tend to run the business side more at a kind of a break even. I think you get into the larger, more kind of AUM grabbers, they find ways to really maximize the management fees, and they'll do things like set up a separate consulting business to consult the portfolio companies, or do underwriting charges when they refinance their deals, and we don't. That kind of goes back to the financial engineering, and we don't really like that as a model to back.
Right. Another question. If we measured performance on committed capital rather than drawn capital, how much does it reduce claimed outperformance v public markets? Marcus, throw that one to you.
I've never been asked that question before. You're very awake for 9 o'clock after a gala dinner. I think it would be a lot lower, but it's not the way that we really measure, because yes, you do pay fees on committed capital in the earlier years, but then that drops down after the investment period to fees on invested. We do certainly model it when we look at the overall fee load, and what we're able to do for our clients is we're able to say, if you want to put a portfolio into place, here's what it's going to look like over the next 4 to 5 years in terms of secondaries, money in the ground day one, co-investments, direct money in the ground, and then what the fund portfolio does. And we also show what the MER would be. So I mean, we'd be happy to actually sit down with whoever that was interested. We can do the modelling based on the committed capital fee run as well.
Tania, is competition in the private equity space an issue, i.e. resulting in too higher prices being paid for acquisitions?
Look, I think, yeah, you know, there is no denying that, you know, there is, due to the capital flowing into the space, there's been a proliferation of GPs, but I would say, you know, the market is somewhat bifurcated. So as Marcus mentioned, you know, the capital chasing the deals and in the most competitive space is probably that mega buyout, larger end of town. And where JANA also likes is probably the lower side of the market, so the lower mid-market end, where you do see competition, but it's not as extreme as the larger end of town, and there is still value. You have to look, but you know, we have a suite of great managers that are still able to extract value, and you're paying your lower sort of entry multiples. You're not bumping heads against other managers. Often a lot of these deals are private. They're not going to auction, and so yeah, I think that with anything, you know, there are pockets of value. You've just got to know where to look.
Do you have a view on that one, Marcus?
Yes, and I think to Tania's point, often they're private companies, and often in the smaller end, they're sort of family-owned, or a lot of the original owners are rolling their stake. So it really matters to them who the next owner is. And, you know, in many examples, you're actually not the highest bidder for the business. There has always been an overhang of capital in this market. I was doing this in the early 90s, and one manager that now has a multi-billion fund raised a £400 fund, and people said, oh, too much money, not going to be invested, and they've continued to do well. You just need to be aware of that overhang, where it sits and what the behaviors are. Late cycle, what we're seeing is a lot of, you take the EBITDA of a company, and then people are kind of padding that out and taking synergies and putting it into the EBITDA price that people want you to bid off. So we'll strip that back to EBITDA, and then often we'll assume that if we're paying, 10 times for a business at this point in the cycle, that when we exit, we might only get 8 times for it. So I think there are mechanisms that you can put in place when you're doing your analysis to make sure that you're not kind of getting caught up in the froth of late cycle.
Do any of you have a view on GP stakes investing and I guess alignment with managers, and how much should they be tipping in of their own coin?
In terms of GPs investing in their own, yeah. So I think that we really like it. It definitely is an alignment to outcomes. It doesn't work in every case. I think for us is we want to have an idea of what their net worth is and how much of their net worth are they putting into the fund versus just a percentage. Because you could be just starting out, but you're putting a high percentage of your net worth into a fund. That's really good alignment.
Tania?
Yeah, I'd echo those thoughts as well, because venture managers probably don't have the capacity to put a certain percentage in, but it's really the pain, personal pain that they would feel, so that they're completely vested in the outcome of the fund. I think that's how you should look at it.
And I think also to Tania's earlier point about knowing the people, you have to know the mindset of the people as well. So I was just sort of reminded of one fund in the US that we heard really good things about. And one of the things that the people really liked was that the founder of the firm put a lot of his own money into the fund. So we go and visit them, and we visit their offices. And as we visit their offices, there are all these paintings just kind of on the floor all around the office, and the assistant is taking you into the room, and do you want a coffee, and do you want a glass of water? And we asked her, we said, oh, it's really interesting, you're choosing art for the office. How does that work? Is that done by a show of hands, or does the founder of the firm have the choice? And she just looked completely startled, and she said, well, of course we got no say in the matter at all. It's all the founder of the firm. He says he absolutely controls that decision. So we decided not to invest. It was a very popular fund. Everybody else was in, and sure enough, a couple of years later, there was a huge blow up, and everybody left. So there's the science, but there's a huge art to investing well in this space.
Do any of you have a view on effective co-investing, or when is it appropriate to co-invest, and in what circumstances?
I think, it goes to a comment Marcus said earlier. I think, a fund has to be, or an investor has to be right-sized to do co-investments. Now, there's a few different access points for co-investments. You can do it in a sort of a co-mingled vehicle, but the true benefit of co-investments is not just averaging down your fees or not paying fees or reducing your MER, but it is also to have more control and insights over the investments. So I think, the actual investment team has to be well equipped to do that. It's not just the expertise, where it's much more of a direct investment versus, a manager selection process, but it's also having the governance and the decision making in place, because often co-investments it's like a transaction. So, you will have a limited time to turn around a decision, and to keep the alignment with the GP so that you can see more co-investments in the future, you do need to have a smooth process where you can get back to the GP quickly so that they can run their process. So I think a lot of investors would like co-investments, but whether they are actually set up to be able to do them directly is probably, needs to be realistically assessed.
I think that's a really good summary. I think one of the things that was attractive about joining QIC is that they've been a direct direct investor in real estate for a long period of time. So they had all that sort of middle and back office and internal tax and legal. And we've done over 40 co-investments, and we've returned in the high 20s net return since 2007. So it has been a really good experience, but then we've got a team of 25 investment professionals, and many of them have come out of sort of aspects of direct investment as well. But we actually seek capital partnering with our managers, and we find ways to help them. It's not always a one-way ask. You know, we're showing them companies and opportunities and connecting them to people as well, and we like to be alongside co-underwriting with them, as opposed to a model that quite a few people do, which is they've underwritten something and then they're selling it down to you, often as a passive investor. So yeah, it's been really good.
And probably the last question we can squeeze in today is, do you believe the use of credit facilities by GPs or funds is legitimately used for cash flow management, or is it a deliberate attempt to inflate performance?
Yeah, we have a view that, it should be very, you can't get away from it. I think we've seen it used with the majority of funds, but it should be for a limited time, and it should be strictly, spelled out that cash management element is what it's for. When you sort of see it going past, into the, a number, the tenor of it extending, then you do have to question, like, what is it actually, is it fit for purpose? So we tend to shy away from those sorts of funds because it's quite transparent, I suppose, what their purpose is for.
I think private equity managers are amongst the brightest, most driven type A personalities around. So you have to understand that. You have to understand their motivations and who they are. Thankfully, there is a lot of choice, and you can find the good ones. On the facilities, I think it's more about managing the IRR and putting lipstick on the pig in the early years of your fund. We've actually just did some research on that, and what we found, a couple of things is, one is that it kind of nets out over a longer period of time. There's also increased transparency coming in terms of having to report kind of with and without your fund facility. And rather surprisingly, when we looked through a large number of managers in the US, a lot of the ones who we thought were using facilities actually weren't. A lot of it was more the kind of the $4 to $6 billion funds that were using it versus the mega ones in terms of in spades. But it all kind of came out in the wash at the end of the day.
Fantastic. Thanks, everyone. That's all we've got time for today. So it'd be really good if you could thank Tania and Marcus for an insightful speech.